Welcome to today's Explainer. We're diving straight into one of the most precarious balancing acts in modern finance. Right now, central banks around the world are walking a razor-thin tightrope. On one side, you have the persistent, nagging weight of inflation pulling them down. On the other, sudden, unpredictable gusts of global shocks trying to knock them off balance. It's an incredibly delicate dance between keeping economies growing and keeping prices from spiraling totally out of control. So, looking at recent earnings momentum, you might actually be tempted to ask, are global markets finally stabilizing? Is the absolute worst of the inflationary storm behind us? It's a super comforting thought, especially when you look at some of the positive corporate numbers we've seen recently. But as we peel back the layers of the data today, you're going to see that the reality beneath the surface is a whole lot more complicated. Okay, let's dive into this. Here is our roadmap for today. We'll be covering the global market snapshot, Australia's crucial rate decision, India holding rates steady, those global wildcards of oil and AI, and finally, wrap up with what all of this actually means for you. Starting with Section 1, the global market snapshot, a cautiously optimistic start. Setting the stage here for early August, global equities have actually been holding up pretty well. Let's look at how this optimism breaks down. UBS is still highly constructive on global markets, and that's really being fueled by that robust Q2 earnings momentum. Over in the US, the S&P 500 is showing solid growth, but, and there's always a but, right? There are some serious underlying questions popping up about the durability of the AI boom and whether that massive tech spending can truly be sustained. Meanwhile, looking over at Asia, it's a bit of a mixed bag. You've got the Nifty 50 essentially moving sideways, while the BSE Sensex managed to carve out 0.5% gain. So yes, there is growth, but it's definitely shadowed by some pretty significant underlying risks. Moving to Section 2, Australia's crucial rate decision, the suspense of a hawkish hold. We are zeroing in on the impending August 11th decision, which has just become a massive focal point for markets. Right now, markets are pricing in a near certainty that the RBA is going to keep their cash rate absolutely steady at 4.35%. And on paper, sure, the case for a pause has definitely firmed up, largely thanks to some recent inflation data that actually came in softer than expected. But here is the catch. A pause on the rate absolutely does not mean a pause on the pressure. Just look at the gap here. Headline inflation is sitting at 4.0%, and core, or trimmed mean inflation, is at 3.6%. But the RBA's target? A very strict 2 to 3%. Now, Federal Treasurer Jim Chalmers has cautiously welcomed the drop in these numbers as a sign that price pressures are finally easing up. But the RBA? They remain incredibly hawkish. Why? Because both of those metrics are still glaringly above that target zone. They've made it crystal clear that monetary policy has to remain restrictive until they are absolutely 100% confident that inflation is behaving itself. And this sets up a really fascinating dynamic between the market consensus and the minority view. On one side, you have the big four banks, ANZ, CBA, NAB, and Westpac, all firmly believing the cash rate has peaked. They fully expect to hold. But then, on the flip side, you've got groups like AMP flashing warning signs. They're pointing out that businesses are just going to pass those rising, elevated commodity costs straight on to consumers. Because of that, they see a very high chance of another rate hike in the third or fourth quarter. This right here is exactly why the rate decision itself might be a foregone conclusion, but Governor Michelle Bullock's press conference tone, that is the real main event. In the finance world, this is as close as we get to a thriller. Any sign of easing hawkishness could send major ripples right through the markets. All right, Section 3. India holds rates steady. A unanimous decision amid uncertainty. Over in India, the Reserve Bank has just concluded its latest policy review. And the outcome? A completely unanimous decision to keep their repo rate unchanged at 5.25%. This actually marks the fourth consecutive policy review where the RBI opted to keep rates exactly where they are. And alongside this, the Monetary Policy Committee maintained a strictly neutral policy stance. So why are they holding so steady? Well, Governor Sanjay Malhotra hit the nail on the head in his policy address, stating, "The global economic environment has become increasingly unstable as the West Asia conflict continues to persist." Basically, the RBI is in absolutely no rush to pivot until the dust settles on these external geopolitical pressures. They want a much clearer picture of the inflation outlook before they make any sudden moves. Because right now, India is facing a truly unique set of headwinds. Unlike other Asian central banks in places like Indonesia and the Philippines who tightened aggressively, India is holding steady while quite literally watching the skies. Uneven southwest monsoons and El Niño conditions are actively threatening agricultural output and, by extension, food prices. It's pretty wild when you think about it. Some of the most powerful financial minds in the country are basically at the mercy of the weather report. Throw in inflation edging up with Q3 expected to peak near 5.9% and all that global trade policy uncertainty looming large, and you can totally see why they're playing it so cautious. Yet despite all of those massive risks, the unpredictable weather, the inflation, the geopolitical instability, the RBI actually raised its real GDP growth projection for FY27 from 6.6% to 6.7%. That is a huge testament to India's incredibly strong domestic engine, which is relentlessly being driven by manufacturing, services, consumption, and investment. Now for Section 4, Global Wildcards, Oil and AI. The unseen forces. These are the unseen forces threatening that delicate central bank balance we've been talking about. On one hand, you have this intense geopolitical tug-of-war in the Strait of Hormuz. Sure, there are hopes for a gradual recovery of energy flows, but Cazenove Capital warns that any re-escalation in the Middle East conflict directly spikes energy prices. And for economies like Australia and India, higher imported fuel costs feed straight into inflation and depress global growth. Then, on the complete opposite end of the spectrum, you have the U.S. Federal Reserve and the tech sector. While we're seeing serious questions about whether massive AI capital expenditures are actually sustainable, the broader U.S. economic picture is showing disinflation. Because of that, UBS expects the U.S. Fed to hold rates all year long. So you're basically looking at geopolitical energy shocks threatening to pull inflation way up, while the U.S. Fed acts as a massive disinflationary anchor pulling it back down. Finally, Section 5. What this means for you. Navigating the holding pattern. Let's tie all these macroeconomic threads directly back to your wallet. The absolute biggest takeaway here is that central bankers everywhere are stuck in a strict wait-and-see mode. Whether it's Australia projecting a tough, hawkish tone to make sure inflation dies down, or India holding the line against volatile food and weather risks, the core goal is exactly the same. They are walking a tightrope, trying desperately to shield their economies from higher global energy prices and geopolitical shocks without accidentally suffocating their own domestic growth in the process. And that brings us to the ultimate question. How long can central banks actually maintain this delicate holding pattern before a global wildcard, like a sudden spike in oil prices or a massive shift in the tech sector, forces their hand? The equilibrium we're sitting in right now is incredibly fragile. The next few months of geopolitical developments won't just be news headlines. They are going to be the very things dictating the interest rates on your mortgages and the actual growth of your portfolios. So keep your eyes on the data, because that tightrope, it's only getting thinner. Thanks for joining me for this explainer. Keep learning, and I'll see you next time.